There won't be any inflation. There is no inflation. Inflation is transitory, and will the final Fed state be inflation is good? That will be devastating, I guess. Welcome to the first episode of Blockrevision. After a longer break than usual, my name is Rafał Leszek and welcome to the Market Outlook. Let's begin. And we are going to market movers as the first topic when we discuss over the most important events that may impact stock market prices of previous and the current week. So let's begin. Since 1st of July we had very important gauges for the Great Britain manufacturing PMI, and we can find it's a little bit lower from as it was expected, but still at a very high level. As we can find in here, manufacturing PMI is still above 60 points. It means this gauge is generally supportive for the Great Britain. The next one, on Thursday we had initial jobless claims. That's also very important as that measures the number of people who filed for unemployment insurance for the first time during the past week, and we can find it's still it was very close to as it was expected, but finally it turned out to be a little bit lower. That is also supportive for the US dollar, and as you can find the chart of the previous weeks looks like this, and after this post-pandemic break up, we can find we are calming down. This is better reading, and this was the situation on that day. So we have been a little bit lower than expected, and at a little lower level than it was in the previous week. And the next one, on Monday we had the composite PMI for the Great Britain, and we can find that composite PMI index was a little bit over 60 points, and as we can find we are right now at the all-time highs levels. So the 60 points means that we are in an expansion phase of this sector, and it looks like support for the Great Britain. Next one we can find, we had ECB President Lagarde speaks. That also was quite important event. I would a little bit get backwards in what was happening on Sunday. We had catering services PMI for the China, and it was a little bit surprising because we can find this level just got us just above 50. We are still in an expansion territory, but it's another month of a similar decline, and we will have the first Chinese contraction confirmation since last February. So yeah, it's not very bullish right now for the Chinese yuan, but it's still supportive. The next one we can find, we had on Tuesday we had the construction PMI that was higher than expected and higher than the previous one. And for the US we had ISM non-factoring PMI. So the ISM reading we can find that's non-manufacturing PMI measures as reported is based on data compiled from monthly replies to questions asked of more than 350 purchasing and supply executives in over 62 different industries. So we can find the ISM was lower than expected, but still at very, very high levels, as we can find here, still above 60, but it's like a boom after this drop in May 2020. Afterwards, we can find on Wednesday we had IVE PMI for Canadian dollar, and we had for the US dollar EIA short-term energy outlook. Afterwards, we had a FOMC meeting minutes, and that had potential to shed further light on the hawkish shift that saw the median dot move to project 2 rate hikes in 2023. However, it wasn't it hasn't changed anything special. Monetary policy was expected was introduced as expected to remain loose, as I guess as concerns about inflation and rapid economic growth fade. On Thursday, we had initial jobless claims. Here we got 373,000, and it's a little bit more surprising that the forecast was. So we can find there are some of the gauges that are lowering regarding the previous gauges, and some as we can find it, there are revolving around specific levels. So right now we are at the 350s levels around. On a Friday, we can find we had the GDP for the Great Britain, and that was 0.8. The 0.8 month over month gauge we can find is much lower than it was on June and May. However, it's right now, as we can say, maybe it's still a little bit better than the worst case scenario, as it was on registered on March and the January. On Friday we had ECB President Lagarde speaking, and ECB publishing account of monetary policy meeting. And despite the prices paid measure hit its highest since 1979, we didn't see any drastic measures in regarding the inflationary like prevention, and therefore we can expect there to be continued this such as focus on signs of inflationary pressures. On Tuesday, we already had a very important level that was introduced at 8:30 Eastern Time in US, and it's core CPI. Core CPI is a measure that changes in the prices of goods and services, excluding food and energy. And we can find this measure was higher than expected, and as you can find here on this chart, it's still above 0.5. That is higher than any of this any single gauge that was introduced during the past 4 years. So we can find that may be a little bit threatening to the development, to the expansion of inflation in the US. However, it's still not at the worst levels. And on Wednesday, we already have the PPI gauge that may tell us a little bit more how the economy is getting back to normal after this post-pandemic economic crisis. And as we can find, we are just over 0.5 level. That is still a much higher indicator than it was ever before by February of 2021. So it's right now it's decreasing, so it may be a sign of getting the economy back. However, it's still a lot need to be done. So we could find the on that situation may Fed Chair Powell testify as well. And a very important indicator after was GDP from China year over year, as suggested, will contract from 18.3 to just above 8%. So such contraction is not a very good sign for any of the economies around the world, because after this post-pandemic breakdown, we need a little bit stronger boost of the GDP, and the lowering this gauge by about 10% is not very optimistic at all. For this upcoming week, the very important also, in order to check how the prices will move, will be earnings season. So earnings season, as we entering the second half of the year, will bring us lots of interesting data in order to identify how the economy expands, and investors, obviously, because there are lots of positiveness on the market, investors believe companies will continue to build on the earnings recovery displayed in recent quarters, it's quite rationally, because more areas of the economy adapt and get closer to normal levels of activity. So right now we already had today JP Morgan earnings. We can find that JP Morgan beat estimates once again in the second quarter. It's very, very optimistic for this bank, and the bank's investment banking arm posted record numbers, and the firm also received a 2.3 billion boost by reclaiming money that had been set aside to cover bad loans. So as we can find on this Reuters website, that head of asset and wealth management Mary Callahan Erdos said on Wednesday that her division of the bank is looking into possible opportunities for add-on acquisitions, and this article was published on June 3rd, 2021, and right now Erdos just added that you've got to kiss a lot of frogs what's out there in order to announcements of any acquisition deals. And we can find on Financial Times that JP Morgan acquisition spree looks set to eclipse previous years, and just in this merely 2021, in the first half of this year, the number of acquisitions of JP Morgan was nearly as high as it was throughout the whole 2020 and 219. So we can find JP Morgan is turning to deals in order to expand the banking giant. And we are heading towards an economy view topic when we discuss over how the things in the economy are going. So first we have Mrs. Daly that says we are on our way back to pre-crisis employment levels, and adds today's job market report just says we are on our way. Daily told CNN in an interview referring to a government report earlier Friday that showed us US employers added 850 jobs in June. So that was previous gauge we were talking about, and she added that she was very confident that by fall more Americans will be returning to the workforce. So the economic data will be in the spotlight during next weeks, including reports on job openings and services activity. However, we have a very important gauge in order to tackle. There are about 4 million people between ages of 25 and 54 in 2020. They are still out of employment. So will we manage to find a few? We can find on Reuters website that US June payrolls top expectations and wage growth looks on the moderate side on the beginning of June. For capital markets, equities and bonds, it was like a Goldilocks report because we didn't scare market, just we were saying we are on the good way, and that was exactly what the Fed wanted to see. If you got too strong report, market could have had a negative reaction in order to be threatened of the probability of saying Fed saying that they can't wait 2 years to raise interest rates, and there would have been concerns that pulls the Fed forward. Right now there are no such. And as we have found on the economic calendar, China is expected to have contracted GDP from 18% to barely 8%. And there are some voices around, such as this one of a former central bank official, that says China should guide rates lower to support growth. And it's a path that is quite different than what the other central banks are doing, because instead of quantitative tightening, we have quantitative easing still, and we can find the policy tightening in the future will have its depreciation and pressure on the yuan caused by rising capital outflows from China once the US Federal Reserve starts to tighten policy from emergency pandemic levels. And the China's policy response was a little bit different from the past rounds of easing, and one of key factors that is observed is a strength in exports in order to prevent the necessity of resorting to mass stimulus in property and infrastructure sectors. Right now we have shortages of materials, hiring problems holding back recovery. So the US central banks admitted that shortages of material inputs and difficulties in hiring have held down activity in a number of industries. And right now we do have also the comparison of supply disruptions and severity of this. We can find on the left there is the severity of supply disruptions for the US, and on the right there is for the Eurozone. These charts may have had the perverse effect of causing many to dismiss the recent high US core CPI readings out of hand. Lots of economists suggest that the problem, and the much higher problem in longer delivery times in the US, is caused by massive fiscal stimulus made by this country. Another news is from the European Central Bank that policy makers have agreed to raise their inflation goal to 2% and allow room to overshoot it when needed, according to officials familiar with the matter. So the previous stand was below but close to 2%. Right now it's 2% exact. So as this stand says, we can find that it may push us to potential interest rate hikes even further in the future, and it would also necessitate more asset purchases going forward. And let's look at longer-term inflation expectations of investors. The US consumers remarked that chain limitations and input shortages may put upward pressures on prices into next year. And as we can find, there's right now at this level is at 2.8, and it's highest since 2014. So right now the consumers are really bothered of what may happen in the future.